Hey, how's it going, Chris? Yep, you definitely did not miss it. We're just barely getting started for the night. Welcome in, dude. How are you? Oh, New Year's has been great. Appreciate that. Thank you. Same to you, dude. Yeah, it's been a good start to the year so far. I definitely have no complaints. Um, yeah, trading wise been a little slow. I feel like I didn't catch the entries I needed this time around, but that's not the end of the world. Um, but yeah, overall, nothing to complain about. Hey, King, welcome in. Good to see you. Thanks for doing the homework. Looked great overall. What's going on, everybody? Welcome in. We'll get started here in just a few minutes. Just gonna get started probably around like 6:05 my time. How's everybody's Monday been so far? Glad to hear it. Glad to hear it. Yeah, it's been a good Monday for me as well. Nothing to complain about. Um, yeah, I'm just getting used to doing lecture on these days. Some of you may know typically I do Tuesdays. So Mondays is just a little different scheduling wise, but yeah, mostly just rearranging my gym schedule a little bit, but no problem whatsoever. I'm glad we can make it a little bit more convenient for everybody else. All right. I'm gonna send a couple more messages out. Gotta get back to you on the collateral thing. Um, yeah, that is weird. I don't know. I was confused by that, to be honest with you, King. What brokerage are you on? Robinhood. That's even weirder. I was hoping you weren't gonna say that because I feel like I'm pretty used to Robinhood and I feel like I would have noticed something like that on there, but I don't know. Maybe I'll just look past it. Yeah, grab a screenshot and send it to me. I'd actually be interested to see it. I don't. I saw that and I was like, I have no idea what you're talking about. But let's take a look. It just doesn't make sense buying or when you're selling to close a call, unless for some reason it's like momentarily when you have the quantity incorrect or something. Yeah, just doesn't make sense based on what you're doing. But anyway, all good. Okay, let's send one more message in here. Cool. Our lecture starting. All right. Sorry, just getting this last message posted and then we'll get going. All right. I think I've spammed the link enough tonight. All right. Well, welcome in, everybody. Thanks for making the time this evening. This is the second lecture of our course series. One thing that I want to do in this iteration of the beginner's course series is just start the beginning of our classes with kind of a recap of what we covered in the prior lecture before we get into our content for this lecture. So we'll just start very briefly and just kind of recap what we took a look at in our prior lecture and just flip through some of the slides really briefly. So for those of you who were here or weren't here, this was our first lecture of the course series last Monday, where we talked about just very generally kind of introductory concepts into the stock market, what it is, how it operates, and then some of the basics of options contracts as a whole. We also introduced kind of the overall layout of the course series and how it's going to operate. Yeah, first major question we answered is what is a stock market? We talked through the difference between a stock market, stock exchange, and the stock indexes. Did a little history with kind of where technical analysis began and where we are today. Then we continued through and started talking about some of the basics of options. So we talked about what the difference between calls and puts are, and we talked about the properties of an options contract. So we talked about kind of all the different aspects and things that you need to be aware of when first selecting a contract. We also discussed what in the money, out of the money, and at the money mean. It's going to be a little bit different for a call versus a put, but in general, pretty simple. We ran through a couple exercises as well for kind of what each of those mean. And then we ran through an exercise on calculating intrinsic value and extrinsic value. And the homework for last lecture was basically a assignment for you all to go find a call and a put option on the same stock and just break down a quick summary explaining and noting down some of the properties of that contract. Most things are pretty intuitive, like strike price, expiration, premium. That should have been pretty easy. The one that I was most interested in seeing what people's responses were was this max risk. And I just wanted to highlight this and discuss this very briefly. Everybody who did the homework got this right, which I was impressed by because we didn't really talk about it. And I don't know, it's not that hard. So maybe I shouldn't be too impressed, but we never discussed it and how to do it, and everybody got it right. So the one thing that I just wanted to mention on this max risk piece from last week's homework was that in general, the absolute maximum risk when you enter any position is basically what would happen if that position goes to zero. So for example, if we spend $100 on a call, well, the worst case scenario is that call is worth $0 and our max risk is $100 because we lost that $100. Same thing goes with equities. If you buy, 10 shares at $10 per share, that's a $100 investment. If those shares drop to $0 a share, the company goes bankrupt, all of a sudden you have $0 left. So when you're buying to open a position, meaning trading money for an equity, trading money for an option contract, the maximum amount of risk that you could possibly incur is the total amount of money that you put into that position. Things certainly change when you start selling to open positions. So if you go, shorting a stock, technically your risk is infinite, right? Because a stock could technically go up infinitely. Same thing if you did like naked selling to open calls and puts. You technically are also opening yourself up to significant amounts of risk, not as much to the infinite side of things. But anyway, yeah, I just wanted to highlight that. Everybody did great, and I appreciate everybody who did the homework. I think we had a decent participation. There was like midweek and I didn't get any, and I was like, oh man, this kind of sucks. But yeah, a lot of you guys took the assignment on and did a great job on it. So thanks for doing that, and we'll have another one at the end of today's lecture. So with that, let's go ahead and get right into it. Will you be covering what happens if you have to buy the underlying stock and how to avoid that? So I wasn't specifically planning on covering that nut. And the reason being is because this is meant to be a more beginner focused series. And as a result, we're not really discussing many like advanced strategies like selling to open calls or selling to open puts. With that said, I could just briefly kind of summarize. Maybe if you want to send a message, you and I could have a discussion on it. Or if we have time at the end, I can revisit that question. So if you're still here at the end, just send it again so I don't forget, and we can talk about that. Cool. Yeah, it's kind of nuanced. I'll have to learn more about what specific scenario you're asking, but yeah, anyway. Okay, let's get right into this one, everybody. Just a quick question before we get started. How many of you were not at last week's lecture? How many of you is this are here at the beginner course series for your first time in 2026? Is there anybody here this time that didn't make it to our first one or didn't get to see the recording of our first one? Cool. Nice, Chris. Thanks for watching the recording. Hopefully it turned out all right. And thanks for being here tonight too. Okay, so it seems like literally everybody here was at last lecture. So that's great. If you're being silent and not sending the message, that's okay too. We'll just do a brief intro. So here's where we're at in the beginner's course series. As a quick reminder, 12 lectures, going to do them weekly on Monday, same time, same place. I'm sure I'll have to deviate from the schedule once or twice because there's going to be something that comes up, I'm sure, but I'm going to do my best to keep it Monday, 6 p.m. EST or 6 p.m. PST. Can't talk. And we got 12 lectures. We're here on number 2, covering stock options, Greeks. These first two are really going to be kind of the most basic, base level classes. And as we continue to progress throughout the series, we're going to increase in complexity and we're going to spend less time in the PowerPoint and more time reviewing charts and things like that. But for now, just mostly focusing on covering these most fundamental concepts. And as a reminder, two main goals for this course series. The first is to hopefully to develop a bunch of successful traders who can find and execute on the highest probability trades and act on those opportunities with confidence. I won't dig too much into that goal since most of you guys were here last time. And the second piece, which is going to be mostly facilitated by you all doing the homework. First one is kind of for me to help make sure I'm driving home. Second one is really for you to all participate in, is teaching you all how to apply the techniques discussed in this course series. And I'm going to give you, optional homework that you guys can choose to do or not do. And obviously, the expectation is that you'll continue to apply these concepts, even if somebody's not giving you homework. So yeah, hopefully some of you do the homework on this one as well. It'll be at the end of the class. And as far as today's lecture, kind of like I mentioned just a little bit ago, today we're mostly going to cover the Greeks and then just some introductory rules for selecting contracts. So this one might run a little bit shorter than last week. We might be able to get you guys out of here maybe closer to 6:45, 9:45, but no promises. So the Greeks, let's talk about it. What are the options Greeks? Well, there's 5 main what are called Greeks in options contracts. And these specific parameters are unique to options contracts. We don't see Greeks like this for stocks or futures or other similar related asset classes. These specific Greeks that we're going to cover tonight are all specifically related to options contracts. And there's going to be 5 main Greeks. And why are they called the Greeks? I can't specifically tell you, but what they are in general is they're basically a property of an option contract. They're something that is related to the option contract's price. These 5 main Greeks help determine what the price of an option contract is. So you guys might have wondered, the price of an equity is hopefully pretty easy to figure out, right? The price of the equity just kind of goes up and down as demand rises or falls. As more buyers step in, the price goes up. As more sellers step in, the price goes down. The initial price of an equity is, set by the IPO team and based on demand. So if a company says, I want to IPO at $20, their partner banks are going to help them do that at $20 and find enough buyers for them to facilitate that. And then whatever the stock trades at after that is basically all in the hands of the market. If you think about if you forget about share splits and that sort of thing. But option contracts are a little bit different, right? If you look at the options chain, and I'll just pull that up really quick on another screen. So let's share that real quick. So if you look at the options chain over here, you'll notice, there's a bunch of prices on every single contract. This is for IWM, and you can see here, this is going to be the ask side here on the right. We have, 423 at the ask, 398 at the ask, 373, 327, 285, 247, 213, all the way, to 121.74 being 12K. And you might be wondering, where do these prices actually come from? Because options are a little bit different than stocks, right? The price of an equity, the price of a stock moves up or down based on demand, right? That's it. Once it's IPO'd, it's all based on demand, buyers and sellers. It's the auction market process that we talked about in our prior class. Options aren't quite the same, and there's a little bit of an asterisk. You certainly can influence options prices based on demand, but that's usually lower volume contracts. Outside of that, option contracts aren't going to be influenced by demand. So let's talk about it, right? What actually gets us that price? Well, there's a pretty complex mathematical equation that uses these 5 main Greeks and more, but let's just leave it at the 5 main Greeks to compute what the options price should be at any given moment in time. So we have delta, theta, gamma, vega, and rho. And just to summarize them briefly, we have this graphic that I took from somewhere a long time ago. And to keep things brief, Delta represents the sensitivity of an options price to changes in value of the underlying security. That's a pretty wordy definition, and we'll go into it in a little bit more detail, but all you need to know in this overview is that if the price of the stock goes up, our delta tells us how much the options contract is going to go up or down. That's delta. Then we have theta, right? Theta is going to be that time decay component. So as time passes, like it always does, time never stops, that theta component is eating away at the value of the options contract. And that theta is slowly increasing and increasing as we get closer to expiration. And once we get really close to expiration, that theta starts to increase at an exponential rate. So it starts rapidly increasing and eating away at that contract value. Gamma, to put it simply, is the rate of change of delta. So that delta is what represents our option contracts price change with respect to an increase or decrease in the price of the underlying. The gamma is how much our delta will change if the stock moves up or down. And this is where we start to get into maybe some second order Greeks, right? So delta and theta on their own are pretty simple, right? These are going to be some of the largest components to what an options price is. These are going to be in general the most significant things, especially as a beginner, to be mindful of. And these three on the right are going to be a little bit less significant in terms of, your initial day-to-day stuff. Vega is a less significant one. It's going to be one that most of us probably don't ever really care too much about. Vega is going to represent an option sensitivity to volatility. So as volatility in the underlying asset rises, that's typically going to be represented using a metric called implied volatility. That Vega component is going to make the option contract worth more. And some of you guys probably have seen this before. Like, for example, if you're trading a stock going into earnings, that implied volatility goes up, right? Because market makers know that when a stock has earnings, it moves more than normal, right? A lot of us who have seen a stock move on earnings probably know this. If you look at something like NVIDIA, for example, NVIDIA is a great one to take a peek at. We can see now the average daily move of NVIDIA is around 2.5%, right? Not too big. But if we look at a lot of its moves on earnings, especially back through 2022 and 2021, let's just go, well, I guess even 23 is probably a good example. Here is one of its earlier earnings reports, right? We can see it denoted down here on the chart. NVIDIA increased 17% in a single day there. Here, 8.5% in a single day. In this range, it was a little flatter. So anyway, the most important thing to note is that market makers know, and this is a good one too, this was a huge day. This was a basically 20% move into earnings. So market makers know, oh, I just realized that you guys probably can't even see that screen. Sorry about that. Sorry, my fault. I forgot I was just sharing the window. Let me go back over there. I was just talking to myself for 2 minutes. Yeah, so sorry, on the NVIDIA chart, here you can kind of see, again, in the top left, we have our average daily move of the stock. Don't worry too much about that. You'll just have to trust me for now that it's about 2.5%. And on earnings, we can see, we jump here about 7.5%. Here looks like we dropped, let's see, around 6.5%. So what you need to know is that Vega is going to increase the price of a contract as we get closer to a major event like earnings. And we'll talk about all these definitions in more detail too. This is just a quick overview. And the last one is almost one that we could probably skip covering because it's really that insignificant. But the last one is called Rho, and this represents an option sensitivity to interest rates. So this one, for example, is typically going to be based on the what's called the risk-free rate, which is going to be set by the Federal Reserve. So what that means is as interest rates are reduced by the Federal Reserve, we'll notice a small change in options prices. And when interest rates are increased by the Federal Reserve, we'll notice a small increase in options prices. And this is one that's like super hard to quantify and just has such a very, very small component to an options price to the point where it really doesn't matter. I'm sure it was much more significant back in the 80s when, we saw rates swing from 0% to 8% to 5% to 13% in like 3 years. But, in this day and age, it's really not nearly as significant as it used to be. So that's just a quick overview of all the Greeks. I wanted to just introduce their names and their ideas before we get into the details. But what we're going to do next is we'll have a detailed overview of each and some graphics to help us understand them all. Chris has a good question. Am I going to teach you guys how to read the charts? Yep, absolutely, Chris. That starts actually next class. So next class, we're going to start looking at candlestick charts and introducing, what those are, how to understand them. So yeah, definitely join us next week. We're going to get into all that. You got it. Good question. Okay, so the first one, like I mentioned, is delta. And this one is going to represent how much an options price is expected to change per $1 change in the price of the underlying. So just a quick graphic for us to look at. Actually, I don't want to look at that one yet. A quick example for us to discuss, right? Let's say, for example, let's just look at IWM actually. We already have that open. Let me reshare here. Just share this whole window, make it easier on myself. Let's look at, oh, we got NVIDIA up. Let's look at NVIDIA. So for those of you on mobile, it might be a little hard to see, but in this far left column here, we have our delta. In this second column from the left, we have gamma. Third from the left is theta, and fourth from the left is vega. So if we look at this 185 strike call, we can see a delta of 0.51. And this option contract is about $600. So every time NVIDIA moves up $1, this delta is going to move the option contract up $50, right? So NVIDIA moves up, let's just say a fraction of a percent. This option contract will move about 8%, right? Let's look at a 200 call, for example, right? The 200 call costs about $110. The delta on that guy is 15. So when NVIDIA moves a dollar and we hold this contract, we're going to get about 15%, right? Because our contract's going to go up by about 15 bucks. So that's kind of how delta works, right? Delta is one of the larger components that's going to influence our options price. So again, as price moves up, those call options gain value, and that's that delta component, right? That delta component is what's going to give our option contracts more value when price moves up or down, more or less value. And then puts are going to have a negative delta, right? And this should be pretty intuitive because when price goes up, puts lose value, right? We don't want to be in puts when price is going up. That means we're going to lose money. So as a result, if we're in the 185 strike puts and price goes up a dollar, these puts are going to lose 50 bucks, right? They cost about $560. So we lose about 10% on this 185 strike put if the NVIDIA stock went up about a dollar. So that's how delta works, right? It's pretty simple. It's really just a proportion, right? That delta gives us a proportion of how much an option contract will move relative to an individual equity. And what you may or may not know is you could think of option contracts almost like leverage, right? An option contract is going to multiply your risk and your reward when trading. If you spent $100 on NVIDIA stock and the stock goes up 5%, you would now have $105. If you spent $100 on NVIDIA call options and NVIDIA went up 5%, you'd probably have 30, 40, 50% gain, depending on the contract you select, maybe more, right? Who knows? Conversely, right, if NVIDIA drops $5, you might be down, or 5%, you might be down 40, 50, 60, 70%, right? So option contracts can certainly work in your favor, but really important to know that they also increase your risk as well, depending on how they're used. So like I mentioned, call options have positive delta and put options have negative delta. So as our stock price goes up, those call options are gaining value. And as our stock price goes down, those put options are gaining value. And the last thing to note is as we get deeper in the money, the delta of our calls approach 1 and the delta of our puts approach -1. So if you take a look at this, right, we can see right at this at the money strike for basically our 185 calls, our delta on the calls is about 0.51 and our delta on the puts is about -0.5. As we get further out of the money, you can see delta drop off to 0 pretty quick on both directions of the options chain. And as we get further in the money for calls and further in the money for puts, we can see that delta increases to 1 pretty quick. So that means when the delta is 1, if our stock price moves $1, our option contract is going to move 100, right? And it might sound off the top of your head, it might sound like, you always want that delta to be 1. If you think about it, right, a 1 delta on a $20 or $2,000 contract is only going to generate you a 5% return when the stock moves a dollar, right? Which, depending on the stock, a dollar move might be huge. But for example, if we went something, that was maybe a bit more out of the money, we would now have a 10% return on a $100 contract if the stock moves a dollar, right? So anyway, there's different times and places to select different types of contracts. I won't get into it too much now, but just want to introduce that thought process. And this is kind of a graphic that just represents what I just showed you on the options chain there. So we can see for both puts and calls, when we get pretty far out of the money, those contracts don't respond to price at all. They're just not realistic to be involved in. As we get closer to the money, so once we get at the money there, we can see, and you can see it in the real world too, that delta approaches right around 0.5 or negative 0.5 for puts. So this is the at the money strike on NVIDIA. Let's look at SPY for a different expiration. So you know it's not a fluke. Here we can see SPY's at 695, 16. So our at the money strike is going to be 695. We can see here a delta of 0.49 on the calls and negative 0.52 on the puts. So not perfect, but pretty darn close there. And also this might be factoring in the last 15 minutes of price action, which could have changed things a bit from our actual close here. This is an interesting question, Roll Tide. Is that why your cons gain more profit as they get deeper in the money? So from a actual dollar standpoint, the answer is yes, right? Because as you get deeper in the money, your option contract is going to increase more in dollar value because of that delta component. However, from a percentage component, you won't perform as well as an out of the money contract, right? So in the money contracts have some benefits that we'll talk about later. So do out of the money contracts. But on a percentage basis, in general, an out of the money contract will always outperform an in the money contract. Just because those out of the money contracts are going to be cheaper, they still have a decent delta, right? Depending on how far you go out of the money. And we'll just do one example real quick, right? So this is SPY. Let's look on the call side of the chain here on the left. 700 strike calls cost you $1.50-ish. And the delta, let's just round down to 0.25, right? So $1.50 and 0.25. If the S&P goes up $1, which is not even, two tenths of a percent, this contract will be up. Let's do the math in my head here. Let's just say around 20%, right? I'm doing a lot of rounding, but this contract would be about 20% up when SPY goes up about $1. And if we look at these at the money contracts, well, let's go in the money, 690s, right? If we look at 690, these are about 750 and the delta is about 66. So if these go up $1, we're not up even, we're up about 10%, right? So from an actual dollars perspective, this contract is up 66 and this 700 is up $27, right? So if you're just going to buy one contract of either, you're in the money is going to make more money there. But from a percentage return basis, that out of the money is going to provide a better return. And also it's going to be more risk, right? You can't have risk without, or you can't have reward without risk. So I don't want to make it seem like everybody should be buying far out of the money contracts because you can make so much money on them. You can lose a lot too, right? So there's a balance to be had there. Is that why you're, oh, sorry, I already answered that one. Is that because of more intrinsic? Partially, Scotty. Intrinsic value certainly will take over once you go in the money. There's no denying that. But really, it's just that it's one way to quantify it, Scotty, is the ratio of the delta to the price of the option contract, right? That's one metric that you can look at. And as an option contract goes further in the money, that ratio is going to decrease because you can see in this graphic, right around here, right, this range between kind of decently out of the money, like a 0.2 delta, and decently in the money, like a 0.7 delta. That's where the slope of this line is the steepest for the most part, which is mean in general, this is going to be kind of our most favorable region. And as the slope of this line starts to drop off, we're getting lower and lower returns on a percentage basis for more and more of a dollar investment. Yeah, so let's say, for example, Ander brings up a suggestion. So you have some in the money contracts for middle of next year. Am I suggesting to sell and rebuy some other out of the money contracts? So that's absolutely a strategy that some people might follow. That's something that I've done in the past. When I've had a position that goes super deep in the money, sometimes I'll trim that and then go ahead and roll the profits into something further out of the money. Usually when I do that, I also add time to the position as well. But that is definitely a methodology. You're in Zeta 20s, June 18th. I can't tell you how to manage your money. I can't tell you what to do. But I don't think there would be anything super wrong with you doing that, right? And one way that I would go about it personally, if it was me making the investment decision, is I would probably secure some profit in the deep in the money contract that I have and put a fraction of that into maybe a farther out position. So not only am I securing profit, but I'm keeping my exposure maybe even equal to what I had before while reducing the overall dollar value that I have in that position. So let's say I have, $10,000 in those calls, right? I could sell half of them. So I'm down to a $5,000 position and probably buy, let's say $2,500 in maybe 25 calls, have a lower dollar exposure to the given stock while still the same, I'll just call it a leverage exposure that I would have had when I had $10,000 in the position. That's all hypothetical, but maybe something to consider. Regardless, definitely not at a horrible spot to consider a trim. Either way, good question. Um, yes, roll tide, yes. So out of the money, absolutely can and typically would provide a better return from a percentage standpoint. It also opens the door to more risk on a percentage standpoint. And as you get deeper and deeper in the money, that percentage return is going to start to drop off, right? It's going to be a little bit less significant. I might even try a quick live example on that because you guys are asking some really good questions and I want to just see if I can maybe demonstrate this. So I'm going to open up the SPY chart here. Let's clean it up. And let's look at, let's see what I can find here. SPY 26, let's look at SPY 27 contracts, 2027, 0115. Let's see if I can see how the 500 calls have behaved. So 500 calls, right? Obviously the SPY is now at 695. These are over $200 in the money. This is a really aggressive example, right? So let's check at the percentage return from, the lows to in the money, right? So it took the S&P, once the S&P hit 500 in February of 2024, it had moved around 43%. So let's look at how the option contract did in that time frame. So from the lows to around February of 24. Wait. Oh, I'm looking at two different time frames here. Sorry. I was like, why do I not see February? Oh, this contract wasn't even available in February of 24. Okay, let's look at this low to here. This is a good one. So these contracts were out of the money at the lows down here, right? So April of 25. From April of 25 to getting in the money at 500, this is going to be a harder example. Actually, I guess this is fine. From April to getting in the money at 500, the S&P returned about 3%. These contracts returned about 20% while they were out of the money. And once they got, let's just say $50 in the money, right? Let's check it from 500-ish on 421. This is a super not scientific example to these swing highs around 627. So here to the swing highs around 627. This contract returned about 100% when the S&P returned $50 in the money. So that's about 10%, right? Now that it's $50 in the money, the delta is going to be basically one. So if we look at what it returned from, this basically $600 spot to now, S&P's up 14%. And this contract just very roughly, very, very roughly is up around 40%, right? So this contract did basically 200% when it was out of the money and even a little bit in the money. And now that it's deep in the money, the returns have really dropped off in terms of a percentage basis, right? If we look at what let's say, for example, the 650 contract did during that same period, right? This is going to be from about June 25th to now, which is back all the way back here. This is a contract that was much more reasonable, and this one's up 150%, while that other contract that was deep in the money did about 40%. That was a bit of a crude example, but hopefully that kind of helps get a little bit better of a picture as what those deep in the money contracts kind of behave like. They certainly do really start to slow down. Sorry, I got distracted by some of these names. They look kind of good. Anyway, okay, let's keep rolling. So that's delta. Gamma is a little bit of a simpler one in terms of, now that you understand delta, gamma should be pretty straightforward. So gamma is going to be the rate of change of delta. So if you think back to maybe your high school physics class, delta might be the speed and gamma is the acceleration, right? You could, if you took calculus, gamma is going to be the, I guess it would technically be price derivative of delta, not time derivative. So let's say, for example, our delta is zero point 0.2 and our gamma is 0.1. If the stock increases by $1, our delta is going to go up from 0.2 to 0.3, right? Super straightforward. It's the same thing that delta does to our option contract, right? If we have a contract at $1 at 438 and the stock goes up to 439, our contract's going to be worth about $1.20. And throughout this lecture, I do my best to give kind of approximations because calculating options contract prices isn't really that simple. Like I mentioned earlier, there's a really complex equation that goes into deriving the price of an option contract. And simply saying that, oh, if our delta is 0.2, we're going to be up 20% when the stock goes up $1. Saying that is not sufficient, right? Because as price begins to go up, our gamma is going to start to affect our delta, right? It's not like our gamma waits for a whole dollar change in price to increase our delta. You can see if you look up and down the options chain of the S&P, and if we go back to the S&P 500, go back to the options chain, our deltas are 0.49, 0.45, 0.4, 36, 31, et cetera, et cetera. It's not like it just changes in, whole increments. It's constantly changing. Every single tick, all of these values are getting recalculated and applied to the option contract price. It's always changing. So these examples are very simple. However, these are crude calculations. These are just meant to help illustrate the concepts behind them. And I just want to make that clear. If you go and calculate an option contract and say, oh, the stock's going to be up $1, I'm going to be up 50%, but it takes the stock 3 weeks to go up $1, you're probably going to have a rude awakening when you realize what theta did to you. So this is just a quick graphic of the rate of change of gamma and delta and kind of how those two impact each other. So this is the 25 strike call. So on the x-axis here, we have the strike price. On the y1 axis, we have the gamma value, and on the y2, we have the delta. As you can see, right, when we're really far out of the money, our delta is basically 0. So that's what we saw before, right? This graphic in red should look pretty similar to this line in green here. And we can see, right, once that slope of our delta starts to increase, the reason it's doing that is because that rate of change of gamma, right? That gamma has increased, which is now having that impact on our delta. So there's more that I haven't talked about. There's more second order derivatives or second order Greeks, but this is the idea, right? This is how our gamma impacts our delta. So here we can see, at its peak, our gamma is about 0.2, and at the same time, delta is about 0.5. And we can see in general, as price goes up about $1, roughly we get a delta increase of about 0.25-ish. So it's not perfect, and I'm doing really rough math, but that's kind of the idea. I'll take a quick pause. I know I've covered a lot, and I have no idea how almost 40 minutes have gone by in this lecture so far. I really have no clue. But how's everybody feeling so far? Is this making sense? You guys have any questions at this point?
Sounds good, Tostie.
Thanks, Norman. I appreciate it. And I see your question, Norman. I will look at those tickers for you at the end. I appreciate you sticking with me and yeah, helping us stay focused this one. It's been great, and I'm happy to have you here, buddy.
Yeah, likewise, bro. I'm here to learn.
Cool. All right, everybody. No questions so far, so we'll keep rolling. As always, if you have questions later, you guys know where to find me. So theta, this one's simple and not simple at the same time. Theta is going to be the time decay of options value. And as we get closer and closer to expiration, that theta value is going to increase. So let's just look at something far out, right? This is 18 days out, not too far out, but far enough out. The theta that we see on our at the money contract is 0.25, right? So in about a 24-hour period, we should expect this 695 call to lose around 20 to 30 bucks in value. It's 800 bucks, so 20, 30 bucks, not a big deal. Let's look at our tomorrow expirations, right? Tomorrow expirations cost $1.73 right now, 173 bucks, and our theta is, lo and behold, $1.72, right? So this is basically telling us this contract will be worthless in 24 hours if everything stayed the same, right? Remember, options pricing is dynamic. So if this goes deep in the money, obviously it won't be worthless. But for these other contracts, you can see it's going to be subtracting, or that theta is going to be, it's going to basically get rid of all of our extrinsic value. So this 694 call is about $1 in the money. So it should have about $1 of intrinsic, but right now that theta isn't quite reflecting that. That theta alone would leave us with about 60 cents of intrinsic. Also, though, it is only 60 cents in the money right now, so it might continue to calculate after hours. I believe the S&P chain might do that now. So anyway, that might be part of it. So that's data, right? And here's a little bit of a graphic of it. And this is, again, very simple graphic to just help drive understanding here. When we're really far out, 120 days plus, theta has basically no impact. It's almost not noticeable. Like let's look at the furthest possible contract out, 2028s, right? These 2028 contracts cost $12,000. Our theta is $6. If you spend $12,000 on a contract, $6 of theta, you're not going to notice, right? Your delta is $63. The S&P could move 20 cents, and that's the same as your theta, right? And the S&P will move 20 cents in 10 seconds. So that's nothing, right? The theta on this far out has zero impact whatsoever. And as we get closer and closer, we can see that start to get more significant. So let's look at something that's maybe a little more reasonable, like a June contract, right? Again, looking at our at the money, this is now $3,400 and our theta is $12, right? So still not painful, right? You're spending $3,400 on a contract, $12 theta, again, really not going to notice much, right? It would be hard for you to start noticing the impact of theta. Let's keep going in a bit. That was, what was that? That was June. Let's look at February, right? Middle of February. Now our at the money contract is 1,300 and our theta is $20. So the ratio of theta to the option contract price has continued to increase, right? Our theta has only tripled from that far out of the money, but compared to the option contract, that's much more significant. $20 to a $1,300 contract is a lot more significant than $6 to a $12,000 contract. So now our theta represents about 1% of the option contract value, when before it's got like two zeros before the percentage. And again, as we continue to get closer and closer on expiration, let's look at 10 days out. We see now our theta is about 30 and our contract costs $500. So now our theta is really starting to get significant, almost 5-6% of the contract value. And then again, those tomorrow expirations, our theta is 100% of the contract value. So you can see how theta really rapidly kind of creeps up and gets more and more significant, similar to this exponential curve here. So that's why, a lot of people are going to tell you, if you are planning on holding a contract overnight, basically you're going to expose yourself to, I don't know, approximately 16 hours of theta, because the market closes at 1 p.m. my time, opens up around 6:30 a.m. my time. So about 15 and a half hours of theta. Theta is still going to work overnight. You're not going to see your price update, but theta still is taking a chunk of your contract value away. So as a result, right, if you have something that expires tomorrow and you're swinging it, you better be hoping for a gap in your direction, because if not, you will be down a lot just from the close to the open, right? If price is flat and you see no movement, your contract will be down 20, 30, 40, 50% if you have less than 3 or 4 days till expiration. It will be significantly down. So when you're going to be swinging a short-term contract like that, you really need to hope. Your trade plan really needs to be looking for a gap in one direction. You got to be looking for a gap. And you got to be looking for that gap when implied volatility is low, right? Because if you're swinging a 1 day till expiration on earnings, well, IV is elevated. So that 1 day till expiration is going to be a whole lot more expensive than normal. So anyway, all things to consider. We got a
Tostie,
question from Swim.
oh,
What is it, Norman?
I was gonna ask you, since you're talking about option contract, how can you pick the right one? Let's say like Nike, right?
That's a great question. I'm actually going to come back to that in like 2 slides. I got a couple slides on some general rules on that. We'll come right back to it. Okay. Cool. Thanks, Norman. Yeah. So Swim asks, what's considered a reasonable theta for a 1 week contract? To be honest with you, Swim, I don't have a metric for that off the top of my head. I can't specifically answer that question, because the theta for a contract with 1 week till expiration is going to differ between equity to equity, right? The theta on these S&Ps are $1.70, or excuse me, let's look at 1 week, right? 8 days, that's close enough. The theta on these guys are about 10% of the option contract value. This is 0.31. But if I look at something that's maybe a little bit more expensive, maybe like a Netflix with 8 days till expiration, 11 days is about all I can do. Um, oh, I forgot Netflix split. Duh. That's not going to work. What's something that's expensive? LLY. So if I look at something like LLY, right, the theta is 1.3 for about a week till expiration, and these contracts are much more expensive. So the guidance that I'll give you, Swim, and this is just from my own experience, this is what I personally do. But for me, I typically don't care about theta. And the reason is I don't usually swing contracts with less than 30 days until expiration because I know that if a contract has more than 30 days until expiration, theta is not going to have a big impact at all. It's not going to be something that I really need to be concerned with. Once I start to get lower and lower than that, I know that theta is going to have a big impact. And a lot of the way that I trade, I don't like to rely on me being right immediately, like within hours, right? I like to be able to have a little bit of time on my hands if the play doesn't work out in my direction, that same second I enter. So as a result, I'm always the type of person that's going to buy time on contracts. So for me, I guess one thing that you could look out for is, the delta to theta ratio. That's the one thing to commonly pay attention to. Um, so like, for example, in this specific case, right, your delta to theta is around zero point 0.3, right? So delta or theta divided by delta. So that's something to be mindful of.
Toasty,
Another
can I add something?
Let's come
Real
back,
quick.
Norman, if you don't mind. We're a little short on time, and I want to make sure I respect everybody's time tonight. I'm
Yeah, I
sorry.
was just gonna say something super fast. Like when people play same day contracts, whatever you get on that move, you need to take it because that contract is gonna be worth either zero or Yeah, I feel
That's a
like
great
people
point.
be bag holding.
Yep. No, I think that's a great point. Thank you, Norman. Okay, couple more Greeks to cover, and these ones are going to be less significant, so we'll go through these pretty quick, and I'll come back to that question. Not sorry, I don't know how the time is getting away from me, and I want to try and not rush. Um, so Vega, that's going to be our rate of change in option price per 1% change in implied volatility. And I just wanted to give a quick definition on IV or implied volatility because I know I've referred to it a few times. Basically, IV is going to be the market's opinion on the potential move of a stock. So if IV is high, that means the market is thinking that this stock is going to move a lot for some reason. Could be earnings, could be news, could be an event, could be just the overall market, right? When the market goes into a bear market, IV typically rises because typically moves get a lot larger. And as IV drops, generally speaking, there's probably not significant news upcoming for a given stock, and the market's probably in a pretty stable trend. And the two options I gave are names like AT&T and Tesla, right? Hopefully a lot of us are familiar with these names. A name like AT&T, today it moved 0.12%. That's basically, well within the average range, right? This name is going to move maybe 1 or 2% a day, max. Something like Tesla, the average move on this name is, 3, maybe 4% in a given day. So its implied volatility should be double, maybe triple that of AT&T. And I don't know how many of us have followed the market for a while, but a name like Tesla, you'll hear it all the time. It'll do 10, 15% a day. It'll do 20% in a week, like it's no big deal. AT&T, it doesn't do that. And it's actually had quite the recent run. It did have a 7, 8% day, which I don't know when the last time that happened on this name. But anyway, it's very uncommon for AT&T to make significant moves, which is why typically IV is low. Is the IV percent number for one trading day? What's the general time frame for the IV percent? That's actually an interesting question. Roll Tide, in general, the IV is going to be continuously calculated. So IV is going to always be changing, just like anything. But most of the time, you're not really going to notice a big change in IV intraday. It's certainly possible. But most of the time, you're really not going to see it swing much intraday. You're mostly going to see big changes in IV over a period of days or weeks. So like, for example, on Tesla, and I know some of us might not be familiar with candlestick charts yet, and I apologize for that. We'll talk about it in the next lecture. If I pull up the implied volatility lower chart and we just zoom in, oh, this is T. T is not going to be as good. Let's look at Tesla. Tesla, if we just take a look over its last couple earnings reports, in general, into this earnings report, we didn't see IV trend up much, but into this report, we can see pretty clean trend up in IV. It went from about 0.55 all the way up to about zero point 0.9. But for the most part, it's not going to change super significantly on a day-to-day basis. You mostly want to look out for long-term trends in it. So like Bloom Energy, for example, this is an interesting one, right? This name is up huge and wow, actually looks insane right now. I wish I bought it here. That would have been a nice decision. But anyway, right, once this name started breaking out, IV slowly started rising as this name became more and more volatile, right? So before this breakout, it was around zero point 0.6, and at the peak all-time highs of the breakout, it was all the way up at 1.4. So anyway, another way to see the IV number is in this options chain in Thinkorswim, and it gives you the IV for that expiration and the implied move. So that's pretty cool. And this market maker number here, MMM, that shows you the implied move for a given day, I believe, if I remember correctly. I haven't looked at that too recently. Okay, last one is row. Again, this one is really not super relevant at all. So I'm honestly not even going to mention it for much more than a minute or two. But row has an incredibly minuscule impact on the price of an options contract in our current market because interest rates aren't super volatile like they have been in the past. So basically, if interest rates go up, options prices go up. Interest rates go down, options prices go down. But it's very, very insignificant. It's really not something that matters on a day-to-day basis. Um, Oops, I don't know how I went back. The last thing that I mentioned, alluded to earlier, is second order Greeks. So second order Greeks are measuring how first order Greeks change in response to shifts in underlying factors such as price or other Greeks. So some of you probably have never heard of these terms before, even if you're not a beginner. Gamma is the most commonly talked about second order Greek because that's going to be your rate of change in delta. But there's also things like Vanna, Charm, Vama, Veda, Vera. It's like we're speaking a different language here. But it gets really, really complex, really, really quick. And there's some really fascinating quantitative traders that mostly focus on these second order metrics. And from what I've seen, you can be rather successful focusing on models that really hone in on what these second order Greeks are doing. It's just not something that I've immersed myself in personally, to be honest. But similar to last lecture, I got to at least tell you guys that it exists. It's out there. Whether you go and look into it or not is up to you. But there's much more than what we talked about tonight. We're really just scratching the surface level. I mean, these things get so advanced. I can't stress it enough. Like I mentioned a little bit ago, people have, $1 million funds that are based on these second order Greek strategies and understanding how they change and what they mean about price forecasting and that sort of thing. It's crazy what people can do with these second order Greeks. But again, I don't know too much about them, so not quite qualified to teach on them. Okay, we're almost there, guys. Yeah, sorry, blown over my time estimate a little bit, but hopefully you guys had the whole hour blocked off. I know I did. So let's just talk about just some quick guidance for selecting an options contract. I want to give a preface. This is really just an introduction into this topic. We have a whole lecture on trade planning and selecting contracts, but I wanted to cover it a few times and just give you guys some quick kind of things to think about when selecting a contract. But in no ways should these next slides be taken as like the Bible by any means. Like, don't think that you have to follow these rules that I show you on the next slide all the time. That's not the case. It's just very general guidance, very general thought process for us to start considering. So just things to consider, right? When you're scalping, that typically means you're going to be in and out of a trade in less than 30 minutes. And as a result, it's pretty common for people to trade maybe daily or weekly expiration contracts. And the reason being is because theta is not going to impact us, right? We're not meant to hold the contract for very long. And as a result, we don't really care what the theta is. And for scalping, typically we're trading very small moves. And as a result, when we're trading small moves, we are looking for smaller returns in our option contract as well. So if I can buy a contract for $100 and I can get a delta for 15, right? And the stock moves $1 in my favor, I make 15%. If I try to do that with a contract with a month of time, the contract would move very little, right? It might not even do 5%. So scalping allows me to use those shorter expiration, closer to the money, or even a little bit out of the money contracts to get those kind of quick outsized moves. Um, and kind of continuing with that same line of thinking, in general, day trades you're going to hold for a bit longer, right? So you're not going to be in them for 15 minutes or less, but you might be in them for some amount of hours, right? And again, right, as you increase the amount of time you want to hold a contract, you're going to want to be mindful of what that fade is going to do to you, right? So if I'm holding a contract that expires in the current day, Norman mentioned this earlier, and he's absolutely right. If you're holding a contract that expires today, it's going to start evaporating in value very rapidly. So you'll probably want to add a little bit more time to that so you don't get destroyed for no reason. And then last thing, again, when you're swing trading, you're going to hold for a day, 2 days, 3 days, weeks, months, etc. So really baseline, I like to get at least 2 weeks until expiration. But like I mentioned just a little bit ago, my personal preference is to look for a minimum of 30 days until expiration. Because again, when I'm personally swing trading, I'm looking for a larger move in the stock, right? I'm not a scalper looking for a dollar move. Well, depends on the stock. Maybe I'm looking for a dollar move, but I'm not a scalper looking for a fraction of a percent move, right? I'm looking for a 2, 3, 4, 5, 10%, maybe if I'm lucky, a 20, 30% breakout in the stock. And as a result, I can add a little bit more time, which decreases my percent return, but lowers my risk as well, right? Because now I'm not exposing myself to as much theta decay, which is a benefit. So obviously, kind of blew through that. There's also things to consider with in the money, at the money, and out of the money. Just one thing to mention, I think we covered it a little bit, but those in the money contracts are going to be much less responsive to price action, kind of like I mentioned, and hopefully we showed you a little bit in a few examples. Um, Whereas those out of money contracts, those are the contracts where you'll see double, triple, quadruple in reasonably minuscule moves in price. And let's just look at one example from today. Let's just find one real quick. So let's look at the S&P. S&P, let's see if we can find just the difference between the open and close. So S&P ripped, pretty hard in the first 15 minutes of the day. So let's compare the same expiration. So 2601 12. Let's look at what a 690 call did today. That's going to be in the money all day. Oops. And then let's look at what a 695, or let's look at what a 694 did today. So it opened up a little bit out of the money and ended up closing decently deep in the money. So let's look at minimum to maximum return. So off this opening rip, right? Let's see, 694. From low to high, this contract here did about 178%. This one here did about 280%, right? So a little bit bigger of a return there. And this is our out of the money contract here. But one thing to notice throughout the day is this one seems like it held its value a lot better. Like for example, you can see this contract setting higher lows pretty much all day, which isn't super important. But this contract here looked a little bit weaker. And again, right, that's theta taking an impact. And if you look from the low price to the close price, this one did 256% today, and that was closed about $5 in the money. And this one did about 430% today. This one closed about $1 or $2 in the money. And if we look at a contract that's just a little more at the money, 697, right? This contract literally did nothing all day, right? The S&P ripped basically $6 or $7, even on this massive opening move, right? If we remember, what did the S&P do the first 5 minutes of the day? It ripped like $3, right? That's pretty big. This contract literally did nothing, right? It's just too far out of the money. And you might not think it's that far out of the money. It's $6 away from current price. That doesn't seem that bad. But it wasn't enough today. And another really fascinating thing to note too is look at this drop, right? From yesterday's close to today's open, the stock dropped about 0.5%. This contract dropped 90%, right? That's the combination of theta and delta, right? It doesn't have a very big delta because it's such a cheap contract, but the theta is huge. So that's the difference. That's the difference that an out of money contract and an in the money contract, or a reasonable out of the money contract, can make, right? We could probably optimize for today and say, let's say probably a 695 was pretty decent. Let's see, 695 did, no, 695 didn't do too much better than the 694s. So 694 might have been, the strike of the day in terms of overall return. But that's not specifically something that we can predict. All right, I just want to introduce the homework, then we can take a couple questions. So today we talked about the Greeks and a couple of selecting contracts, a little bit briefer than I wanted to, but we still touched on it there. So let's talk a little bit about this in our homeworks. So our homework is going to be a continuation of what we just did right now. So I would love for as many of you as you have time to select two options of the same expiration on the same stock. So same thing we just did. Look at one that's at the money and one that's, it doesn't have to be far out of the money. It could be close to out of the money. I'll let you guys have a little bit of creative freedom on this. I don't even care if it's at the money and far out of the money. You could do in the money and out of the money. You could do at the money and in the money. Pick your pick, right? Study two option contracts and see the difference between the two. Go ahead and record the Greeks, right? So, and also record the options price. I should have noted that down. And either explain or at least think through which one moves faster with price, which one's decaying faster, and which is more sensitive to volatility. So you may need to have a little bit of price history on this to see how these options change in price related to just changes in volatility. Um, the purpose of this is to help you guys understand how Greeks, how contract selection actually plays in to the price of a contract. And for those of you who are on Thinkorswim, the way for you guys to pull up the chart is by typing a period, then you type in the ticker, so SPY, for example. Then you type in the year of expiration. So for me, I'm just using 26. Then you type in the month. So it would be, 01 for January, 02 for February, etc. So let's see, 01. The day that it expires. So maybe it's 20. Then C for call or P for put. I'll do P. And then you do the strike price. I'll just put 500. And this is what a 500 put expiring today did. Nothing, right? It's so far out of the money, it's useless. Oh, somebody did trade it. Wow, one volume. Somebody had these. Interesting. Anyway, that's that. Okay, that covers us for tonight.
Can,
Um,
can I add something to that,
sure,
Tostie?
Norman. Sure.
Um, I think like if people really want to get the understanding of options, I think the best bread and butter would be find a stock that you really like, trade it, understand it, get familiar with it, um, but try to understand your option contract. Like you don't have to play a spy. You could play either Disney or I've been playing USB. Premiums are pretty cheap. The IV is not killing you on any moving direction, and just get familiar with something, and you don't have to play 50 other stocks. You could play one and bank.
Yeah, I agree. Thanks, Norman. If you don't use Thinkorswim, can you use an options calculator? I don't know if an options calculator will give you the Greeks. Maybe it will. Um, I would say you should be able to use whatever brokerage you trade on. And I believe, I believe you mentioned you were on Robinhood. Maybe that was you, maybe that was Kill. I don't remember who it was anymore. Always be, or was it? Yeah. So I would say go ahead and try getting these data or these data points from whatever brokerage you trade on because it should be available to you and it helps just get you kind of in the workflow of figuring out where these are and making sure you have access. Yeah. Oh, yeah. You could use the simulated returns on Robinhood. Sure. Yeah, that would help you. The simulated returns on Robinhood is actually pretty decent. It doesn't do, I believe you have to manually input IV. I can't remember. But yeah, simulated returns on Robinhood uses a more sophisticated equation, so it takes into account more than just multiple or adding in the change in delta or something like that. Cool. All right. Well, I actually have to run. I know I didn't get to all the questions, and I apologize for that. And Norvin, I know I didn't get to the two stocks that you wanted me to, but send me those in a DM, Norvin. I'll take a look at those. And I know Nut had a question that I didn't get to. So Nut, please send me a DM. I don't want to ignore you. I want to make sure I
Yeah,
get to
one of
that.
them
So
is a laser stock for the
just
chips
send it to me,
is
Norvin. Send it to me.
AXT. Oh
Okay,
my
send it
god.
to me. Send it to me. All right, guys. Yeah, not sorry about that. But yeah, I'll make sure I get to your DM. So go ahead and send that. And if anybody else has questions, please send them to my way. And yeah, whenever you're done with the homework, I'd love to talk about it in DM. So send that over to me. Let's talk about it. And yeah, thanks as always, guys, for making the time. It's always a pleasure. All right, everybody. I'll
There,
see you guys in the
Toasty.
next one. See you, Norman. be share response to Norman's question. Okay. All right. See you guys.